All right. Hello and welcome back to Principles of Accounting 1. I'm still your host, Dr. B. We made it for 15 weeks of the spring 2024 semester together. It's been a long road. Okay. 15 weeks. It's a long time. And we're at the end of our journey together. Today is the last lecture. This course ends on Friday. Today is Tuesday. So that means you have 3 days to get the rest of your work complete, including the final exam. Here's what we need to do. If you have any late work that was supposed to be done last week, or even work before then, I need you to get that done. As I mentioned when we first started this course together, it is almost impossible for you to pass this course without completing all the work. So, what that means is if you're missing any work, late with some work, you need to get that in, like tonight, okay? Because we have 3 days left of this course. The course ends on Friday, April 26th. What that means is anything before this week started and everything up to Friday, April 26th, must be completed by Friday night. I cannot accept any coursework past this Friday night. Meaning, if you try to submit something on Saturday morning, I'm not going to accept it. I cannot accept it. Because the course ends Friday night. Course ends Friday night. Can't accept anything past Friday night. Okay? So, here's what we need to do. For this week, and there's only 3 days left in this week because the course ends on Friday. Within the next 3 days, you have the following things to accomplish. There's a discussion board for chapter 15, week 15. And there's a quiz for chapter 16. In addition to those two things, we also have the final exam. The final exam is also due on Friday night. All right? So you have 3 major things to complete by Friday. And I mean Friday, not Saturday, definitely not Sunday, Friday. That is in 3 days from today. Today is Tuesday. So Wednesday, Thursday, Friday, 3 days. All right? I am strongly urging you to complete as much work as you possibly can within these next 2 days. All right? Today and tomorrow. Because I want you to have some time to focus on the final exam. I don't want you to feel stressed because of the time crunch. You got 3 major things to do all by Friday night. All right? The discussion boards, chapter 16 quiz, and the final exam. So, we're going to talk about chapter 16 now, which is about the statement of cash flows. After this chapter is done, I will host a very brief final exam review session, just like we did for the midterm. The idea here is that I'm going to set you up to be successful on the final exam. Remember, the final exam is worth 20% of your total grade. That's big, yeah? So we need to do well on this final exam. And I'm going to teach you the best way possible how to do that. So, I'm going to go ahead and jump into the PowerPoint presentation on the statement of cash flows. We're going to talk about the statement of cash flows, and then we'll jump into the final exam review. We'll jump into final exam review after the statement of cash flows. Okay, so here we go. In the very beginning of the course, we talked about 4 primary financial statements for accounting. The first one, of course, is the income statement. All right, the income statement represents the revenue coming in from customers and the expenses going out. Then we talked about the balance sheet. The balance sheet shows the balances of all the asset accounts, liability accounts, and equity accounts. The third financial statement we talked about was the statement of retained earnings. It's also known as the statement of owner's equity. The fourth financial statement, which is the one that we're going to cover in depth today, is called the statement of cash flows. The statement of cash flows represents all of the cash receipts from customers coming into the business and for other reasons, and cash going out of the business for payments and things like that. Okay? So when we think about the statement of cash flows, I want you to think about physical cash money, checks, paper, credit cards, whatever, coming into the business and out of the business for expenses. Cash. That's what the statement of cash flows is all about. We're tracking the cash coming into and out of the business. And we do it for 3 different reasons, and I'm going to talk about those in detail. The 3 reasons why cash comes into and out of the business, the first one is operating activities. This is the day-to-day operations of the business. Cash comes into the business from sales that I made to customers. They're paying for their accounts receivable, or they're paying over the counter to receive their goods and services. That's from operations, day-to-day operations of the business. My operations are to sell things to customers. The reason why cash flows out of the business for operations would it be things to pay, like to pay for wages, salaries, rent, utilities, merchandise, inventory, office supplies, you name it, right? Day-to-day operations of the business, you see. The second reason why cash comes into and out of the business is for what we call investing activities. I invest into my company to grow it, typically. How do I do that? I purchase and sometimes sell property, plant, and equipment, fixed assets, property, plant, and equipment. I invest into the company by purchasing and sometimes selling property, plant, and equipment. Of course, it takes cash to do that. Cash goes out of the business to purchase property, plant, and equipment. Cash comes into the business by selling property, plant, and equipment. Those are investing activities. The third reason why cash comes into and out of the business is from what we call financing activities. Financing activities comes from things like bank loans, the issuance of bonds, or the stocks, those types of things. Yeah, financing. I'm financing. You see. So let's talk about these in greater detail. But that's the reasons. These are the three primary categories of why cash comes into and out of the business. So, what does the statement of cash flow tell us? It shows us how the company is receiving cash. It explains the changes in balances. It shows us uh, how and why net income is different from cash flows. It also shows us where and how the company is spending cash. That's why we look at a statement of cash flows. The reason why the statement of cash flows is so important is because it shows us when we're receiving payment and when we're paying our bills. That's really important because it helps us to plan, right? The company looks at how we pay our bills, our debts. The statement of cash flows helps the company to analyze and pursue future opportunities. Helps us to plan day-to-day operations. And of course, it also helps us to make long-term decision making, like investing in property, plant, and equipment. You see? What does cash flow measure? There's two things that cash flow helps us to measure. One is what is our ability to convert our assets into cash. We talked about that briefly. We call that liquidity, remember? Liquidity stems from the idea of converting assets into cash and how quickly we can do that, right? If you look at the balance sheet under assets, we have cash, inventory, accounts receivable, short-term investments, etc. Remember, assets help us to generate sales. That's the idea behind assets. How quickly I can convert something like accounts receivable, short-term investments, inventory into cash. That's one method of measuring the company's cash flow. The second is, are we sufficiently close to maturity so that the market value is unaffected by interest rates? What this means is, do we have enough cash on hand to satisfy interest payments and to satisfy our other debts? Yep. So those are the measurements of cash. As I had mentioned, the statement of cash flows is broken out by three categories. The first is operating activities. Those are the day-to-day operations of the business. Cash coming in from our customers from sales and coming out of the business for expenses related to the day-to-day operations. Investing activities, that's the investment into the company. That's the purchase or sale of property, plant, and equipment. And then financing activities is, as the name implies, financing. Bank loans, bonds, sometimes stock. Those are all financing activities. We're going to I'll go into detail on each of these. First, operating activities. Cash comes in from our customers. Remember, customers pay in one of two ways. They might pay cash up front for the purchase of goods and services, or they might pay us later through that thing called accounts receivable. Remember? We might also get cash in from other operating activities like dividend revenue or interest revenue. Very minor. But overall, we're looking at cash coming into the business from sales we made to our customers, either over the counter or through accounts receivable. And then we got cash flowing out of the business for day-to-day operations, like paying our employees, paying our other operating expenses like utilities and rent and, repairs and maintenance and whatever's. And then we also pay things like taxes, interest, and we got to pay our vendors, of course. But you see how that works. Cash comes into the business from our customers and goes out of the business for our operating activities. That's why we call it operating activities. On the statement of cash flows, you'll see that it starts with cash coming in minus the cash going out, and then we'll have what's called net cash flow. Net cash flow is the balance. It's what's left, right? The cash coming in minus the cash going out equals net cash flow. In this case, cash coming in from operating activities minus cash going out for operating activities equals net cash flow for operating activities. I'll show you what that looks like here soon. The second category, investing activities, as I had mentioned, this is about property, plant, and equipment investing in the company. I purchase and sell sometimes property, plant, and equipment or other assets, okay? Cash would come into the business in this area from selling property, plant, and equipment, short-term, long-term investments, those types of things. Yep. Cash goes out of the business in this area when we purchase property, plant, and equipment or other investments. That's investing activities. Just as operating, we have the cash coming into minus the cash going out of equals net cash flow, you see, for operating activities. And then we have financing activities. Just as the name implies, financing activities would be financing. We took out some bank loans, meaning the cash coming in from the bank loans, issuance of stock, issuance of bonds, cash comes in. Cash goes out of the business when we pay dividends to shareholders, pay back our loans, we buy back stock, we call that treasury stock. Those types of things. So here you can see how financing activities works. When the cash comes in minus cash goes out equals net cash flow for financing activities. Now, you might be wondering, Dr. B, how is all this connected? Okay, you taught us about income statement. You taught us about balance sheet. Now and you talked about retained earnings. Now you're talking about the statement of cash flows. How is it related? How's it connected to what we already learned? Through the balance sheet, you'll see the relationship to the statement of cash flows. Well, how? A couple of different ways. Under your operating activities, cash is the first item on the balance sheet. The cash balance should be equal to the net cash flow balance on your statement of cash flows. So here we can see uh, the current assets, cash, and other assets like inventory, etc., flows onto our operating cash flows. When we pay current liabilities like short-term loans, etc., or through interest, we see that interest expense. That's part of operating activities. When it comes to the long-term assets, that's investing. That's on the investing side. The long-term liabilities, that's financing. See, that's how the balance sheet and the statement of cash flows are tied together, related. Of course, there's a couple of things you'll find that are non-cash related for investing and financing, such as the retirement of stocks and bonds, lease transactions. I don't want you to worry too much about this, but just know that you'll come across a couple of what looks like expenses, but they're not related to cash. Why does that happen? Sometimes there's an exchange that happens. I might purchase a piece of land, but instead of paying cash for it, I might offer a different asset for that land. I might say, oh, I want to buy your piece of land, but instead of giving you cash, I'll give you this piece of machinery plus some shares of stock or some other equity. You see that it doesn't always have to be cash exchange. It could be a trade, if you will. All right, let me show you what the statement of cash flows looks like. Here we have a very condensed version of the statement of cash flows. It looks like this every single time. At the very top of the statement of cash flows, you'll see operating activities, cash coming into minus cash going out of equals net cash flow provided by operating activities. Then you'll see the same thing under investing and financing. Cash coming in minus cash going out equals the net cash flow. We add them all up, okay, to get the change that or what we would call the net. Okay, and then we would add or subtract based off of those differences to get the final balance. That cash balance at the bottom of the statement of cash flows should match your balance on the balance sheet for cash. Should. I say should because sometimes it doesn't. We'll get into that too as well. So there are 5 steps that you want to follow for preparing the statement of cash flows. First, of course, is to compute net cash increase or decrease. Second is compute net cash flows from the operating activities, cash coming into the business from customers minus my payments for operating activities. Then I do the same thing from investing activities, cash coming into the business from the sale of property, plant, and equipment minus the cash going out of the business for the purchase of property, plant, and equipment. And then compute net cash flow from financing activities, loans and stuff like that coming into the business minus the payment for those loans going out of the business. Then I add them all up at the end to get the total net balance of cash. Step 5. So we follow those 5 steps every time. Here we have an example uh, of analyzing the cash account, and you'll notice a couple of things here. This is just a T account. You remember those from, oh, that was a long time ago. I think it was like week 2 of this course. We did those T accounts, remember? We looked at the detail, the level of detail in each account. This one is for cash. So as you can see, we started the year with a balance. Throughout the year, we receive cash from our customers. We receive cash from the sale of some assets and the issuance of stock. Okay, so on the left side is the cash coming into the business. That's our debit side, as you remember. On the credit side, the right side, these are all our payments that we use cash for throughout the business for the year. Notice a couple of different things here. Payment for inventory, payments for operating expenses, payments for interest, payments for taxes, the payment for the on loans, note retirement, and payment for dividends. So there's a couple of different categories here, right? Now let's take a look. Inventory, operating expenses, interest, and taxes. Those are all operating activities. How do I know that? Because inventory, I sell that to, I buy that to sell to customers. That's operating. Operating expenses, guess what? That's operating. The interest expense, that's operating. Why? Because I need to service the loan by paying the interest. Taxes, I pay taxes based off of my operations, right? So all of those areas are operating activities. The note retirement and dividends are both financing activities. Note retirement means I paid back a loan. A loan is financing. I paid dividends. Dividends are financing. That comes from the shareholders, stockholders. But you see where I'm going with this. That's how we figure out which categories each of these payments belong to. So now that I've analyzed that, I can start putting things together. But before I do that, it's important to know that sometimes there's differences between the cash balance in your bank account and the cash balance on the statement of cash flows and possibly even the balance sheet. And usually the reason for that is from what we call non-cash transactions. Okay, non-cash transactions, as I explained earlier, is kind of like an exchange for assets or something along those lines. Okay, so the way we calculate this is we take cash equals liabilities plus equity minus non-cash assets. What this does is it helps me to understand that difference. Now, when I prepare my income statement, I, of course, need information. I got to look at the balance sheet. I got to look at the income statement. And I also got to look at the bank account, right? I got to get the information from those sources in order for me to understand what my balance probably needs to be from the statement of cash flows. There are two ways that we calculate the statement of cash flows. So I'm going to show you both methods. We have what we call the direct method and the indirect method. The direct method, as the name implies, is the simplest. We're taking information directly related to cash. The indirect method includes non-cash items. I'm going to show you what these look like. On the top part of this slide, we have what's called the direct method. The direct method, as I'd mentioned, is related to transactions directly related to cash. Cash received from customers. So that's cash coming in. And then minus all the cash going out. Cash paid for merchandise, wages, interest, taxes. That gets me my net cash flow provided by operating activities, $20,000 in this example. Cash coming in minus the cash going out equals net cash flow. That's the direct method. Now, what about this indirect method? The indirect method, I'm sorry, apologize. The indirect method shows us the net income, and then we make adjustments based off of that net income. We still derive the same total, but we do it using non-cash items. Here's how it works. So we take net income from our income statement. Yep. And then we subtract out, or add in some cases, depending on what it is, changes from operating activities. Our accounts receivable went up by 20,000. So we subtract 20,000. Why, you might ask? Because that means I'm not getting 20,000 in cash from those customers. So that's why it's minus. Increase in inventory minus 14,000. Why? Because my balance of inventory went up, and therefore I didn't use cash for that amount. Increase in prepaid expenses, 2,000, so that's minus. A decrease in the accounts payable, minus 5,000. Why? Because I paid $5,000 in cash for my accounts receivable. A decrease in interest payable by 1,000. I paid 1,000 for that. Increase in income taxes payable, plus 10,000. Why plus? You might be wondering. Because I didn't pay it yet. Increase to taxes payable. You see? I increased that account. I haven't paid the taxes yet. Depreciation expense, 24,000. That's an increase. Remember, depreciation expense, there's no cash involved there. A loss on the sale of a plant asset, plus 6,000. Gain on the retirement of notes, minus 16,000. Gets me net cash flow from operating activities, 20,000. You see the difference, though. Direct method, directly related to cash transactions. Indirect method, no cash transactions here. This further helps you to look at the indirect method to understand those transactions that we just talked about. You'll notice how we find the change on the right side here. We compare the balances from year to year. That's what gives us the change. So in this case, we'll take the new amount minus the old amount. Yep. That gives me the difference. Okay, there are a couple of steps to applying the indirect method that we're going to talk about. The first step, as you can see here, after we found net income, of course, is to look at the expenses and losses from that net income. Depreciation expense, loss on the sale of an asset, gain on the sale of retirement, gains and losses. Okay? So the first step is we adjust based off those gains and losses. The second step that we see down here has to do with the changes in the current assets and liability accounts. Okay? So it's a two-step process. So in essence, the way to think about this is that when we're talking about the indirect method, we're looking at those things that do not impact cash in order to derive the same balance. So we make adjustments based off of non-cash items like depreciation, loss of sale on planned asset, gain on retirement of a note, those kinds of things. This table helps us to understand what to do. Okay, and just a real simple way of looking at things. The chart explains how to treat the change in non-cash current asset or current liability in the operating section of the statement of cash flows. So for example, if there's an increase in the balance during the year for current assets, we subtract from the net income, or for current liabilities, we add to the net income. If there's a decrease, we do the opposite, you see. Helps us to adjust. It's kind of like an adjusting entry. These adjustments are really important because ultimately we need to derive the same balance that we would with the direct method. So that's what you're noticing here. When there's changes in the current assets and liabilities, we adjust for those changes, whether it be up or down. So, in summary, there's two steps. The first step is to, of course, adjust for the operating activities related to the net income. And the second step is to adjust for current assets and liabilities. So that's the indirect method. So we talked about operating activities by looking at the direct and indirect method. When it comes to the investing and financing activities, we usually follow the direct method because it's the simplest and it makes the most sense. When it comes to investing, as I had mentioned, there are three, well, it's property, plant, and equipment investing. When I invest in the company, I'm purchasing or selling property, plant, and equipment, and maybe some short-term or long-term investments. But those are the primary reasons. When we set up the investing activities, we look at things like changes and related to the accounts. We look at the T accounts, and we figure out the effect on cash. Investing activities are very straightforward. We follow the direct method. Here we have an example. We're looking at 2 different years of information. We're trying to figure out what happened here. There's a $40,000 increase in planned assets. So why is that? What happened? Well, we must have done something. So we look at it a little closer and we realize that that the change is related to accumulated depreciation. Okay. That's why sometimes it's useful. Yep. So first we look at the change. And then we make our adjusting entries. So here we have an example. The company purchased plan assets of 60,000 using a note, a loan. So debit plan asset, credit note payable. And then it looks like, what did we do? We sold something at a cost of 20,000. Sold a plan asset of 20,000 for 20,000. So there was a loss because apparently it was only worth 12 based off of the accumulated depreciation. So that resulted in a loss. In the third transaction, we recognize the remaining depreciation expense, 24,000. The third step of the process is to analyze the T accounts. As you recall from week 2, I think it was week 2, might have been week 3. We looked at this thing called T accounts, which, as you know, helps us to understand the balance of each account. It helps us from a visual perspective. But that's the third step. It helps us to verify. We follow a very similar process. So that's investing activities. We follow a very similar process for financing activities. It works the same way. And again, we're using the direct method for this. So the first step, of course, is to look at the difference from year to year. For example, here we see an increase in long-term notes payable. What happened? Well, it looks like we maybe repaid a loan or took out a loan. So what happened? So the second step is, once we found out what happened, to make any type of entry. In this case, we're repaying a loan, or we're paying it early. So because we're repaying it early, there's a gain on the retirement of the debt. So debit notes payable, credit gain on the retirement of the debt, and credit cash. And the third step, of course, is to look at those T accounts and we verify the activity. Other transactions to know about when it comes to financing are things like common stock. As you recall from our conversation on equity financing, when we talked about common stock, that was some time ago. Yeah. There were 3 steps to that process. And that's what this looks like. Don't worry too much about it. I just want you to understand where it's coming from. The same with retained earnings. Follows that same 3-step process. One of the last things we do when it comes to the statement of cash flows is to make sure that our balances are true and accurate. And we do that by summarizing using our T accounts. We also validate it with our balance sheet, and we also look at it from our bank statement. Here we have the summary using the T accounts. You notice that we are shoring up all of our accounts and balancing everything out. This is just an example of what that looks like. When it comes to the statement of cash flows, as you know, there's the operating activities, investing activities, and financing activities. A lot of times we got to know, do we have enough cash on hand? What's the cash being used for? And how can we conserve cash for future investments? Those are the things that management's typically concerned about. As you know, there's a couple of ways to analyze that, and one of those is through ratios. One of these is the cash flow on total assets ratio. What the total cash flow on assets ratio tells us is how effective the company is using its cash to pay its debts. Give you an idea. We analyze cash sources and uses to understand day-to-day operations, make sure that we're generating enough cash to pay our debts, and of course, to make sure our investors are happy, right? That we're able to pay dividends. So the cash flow on total assets ratio, we take the operating cash flows, operating net cash flows, divided by average total assets. You may recall, to find the average of anything in accounting, we take the beginning balance plus the ending balance divided by 2. That gives you the average. If you are interested in preparing a statement of cash flows, I always recommend doing it on a spreadsheet using Excel, right? Here is a classic example of what a statement of cash flows looks like using Excel as it shores up or matches to our balance sheet. So this Excel spreadsheet shows us the balance sheet, assets and liabilities. It shows us the statement of cash flows for operating, investing, and financing activities. This type of worksheet using Excel helps us to organize the information and also helps us to validate the information as well. So just something simple you can do. The direct method is, as I'd mentioned, the easiest method because it simply uses cash balances. The indirect method, that's the more complex one that uses non-cash accounts. Looking at the direct method, the simplest method, we take the cash coming into the business from our customers minus the cash going out of the business for our day-to-day operations, gives us the net cash flow. That's the direct method. I personally always prefer the direct method because it's the easiest. The indirect method can be somewhat complex, so it's just something to think about. This slide just kind of helps us to summarize it. And that, my friends, is the end of our discussion on the statement of cash flows. As I had mentioned, the statement of cash flows is the last of the 4 primary financial statements that we looked at in this course. The statement of cash flows, super important for managing the operations of the business, knowing when and how to pay for things, and also when and how we're receiving cash from our customers. Helps us to plan, it helps us do a lot of things. So, the couple things related to the statement of cash flows. In the classroom, one is a discussion board. 7 quick questions, okay? Some of your colleagues are already in here working hard. Thank you, Jordan. I see you. Wow, this is really cool. Jane's got some good stuff here. Marlon, thank you, Marlon. So as you can see, your colleagues, thank you, Maria, your colleagues are working hard already. So please jump in there, answer these 7 questions, do the best you can with it. Again, it's all hypothetical stuff, but, do what you can. And then make sure you respond to your classmates. That'll help you to get the full 10 points for the discussion question. Again, this is due on Friday. Not Sunday, Friday. Last day of class is this Friday, as I had mentioned several times already. So please jump on this today, and let's wrap it up as quick as we can. The other thing related to this chapter, of course, is the quiz. And it's just like your other quizzes. So please make sure we get that done as well. Are there any questions about statement of cash flows, anything that we just covered before we switch gears and talk about the final exam? Anything at all? Are we feeling okay? It's a lot of information at once, I know. Are we feeling okay, everyone? Thumbs up, yes. Yes, no, maybe. We all right? Okay.
Yes. Yes.
All right. Thank you, Maria. Okay. Very good. If you have questions, you just let me know. So, okay. I'm going to stop this part of the recording and we're going to start a new recording for the final exam. So please stand by while we switch gears.